Thank you so much. What an introduction. How are you guys feeling on day 3?
Awesome.
A little bit louder. How are you guys feeling on day 3? Okay, there we go. So I'm a CFO, a financial strategist. I work from brands anywhere between 1 to 15 million, and I help them expand their business or exit their company. So typically for expansion, I help them raise capital, I work with a lot of beauty brands, so get into retail, get into Sephora, or exit their company to a larger company. So the reason that I like talking about expand or exit, because at some point, you want to really think about what does your exit strategy look like. So I want to help you guys build something that's investable. I want to help you guys build something that's an asset. So even if you never plan to sell or never plan to raise, your business is still going to be sound and you're still going to be able to expand beyond yourself. So most of the time when women kind of build these things, we build lifestyle brands. We don't actually build something that's like the next 10, 20, $50 million company. And I work with, unfortunately, a lot of men. No offense, guys. But I want to see more women in the rooms when we have these conversations of I'm raising 20 million, I'm raising 50 million, because we all have the ability to do that. We have this ability to build something bigger than ourselves, but we don't have the knowledge or honestly just the confidence to be delusional enough. So hopefully after today, you have all the tools and resources you need to be delusional enough to build that next $50 million company or even raise 50. You guys will notice very stark differences. What is required to get to that next level is not what you're doing right now. So I want you to truly ask yourself, how much of what I'm doing right now belongs to that version of my business? The version that's gonna make 1 million a week, 4 million a week, whatever that looks like. Because you need to build that infrastructure right now. You don't just wake up one day with a $5 million company or a $10 million company. You build that operation system right now, and that's how you're able to support it. So right now, a lot of you guys are probably realizing you don't have the team to scale. You don't have the infrastructure, so she said I need like a software. That's so funny that you said that, because that's usually what it comes down to. It's like the technological advancement that you need to be able to scale that business to the next level, and a lot of people don't have that. So there's 2 types of ways to be successful in business. You either expand, you build something really big, you become a market leader, or you exit the company. So whatever decision you guys make, I want to make sure that you're building the company investable, so that way you can do either or. So to build a business, to be able to expand, you need market visibility. You need people to see you. You need people to know who you are. And then typically the next step is increasing revenue streams. So far too many of you are depending just solely on selling the product and selling the service, and you don't have a real ecosystem of revenue coming into the business, which is why you cannot make this number per week. Scalable business model. If you're the sole person that the business is dependent on, it cannot scale beyond you. If you're the smartest person on the team, it's never going to scale beyond you. And then expanding through acquisitions. Every major successful company has expanded through acquisitions. They've acquired another company, and there's a reason for that. And so then, of course, market dominance. This means that you have a significant amount of market share. So all of the consumers that are within your industry, they think of you first, or they go to you. That's how you know that you've truly expanded the company. Or exit. So this means that you are removing all of the owner dependency. It no longer depends on you to function. Whether you're here right now or you leave for 2 months out of the year, the business is still going to operate the same. Enhancing the financial health of the company. It's not enough to just have a P&L that looks good. You have to look good to investors. You have to look good to anyone that's coming in to audit the business. And then protecting the business value. So this means that all your contracts are up to date. This means that you and your lawyer have ongoing communication. All of your IP is protected, because no one wants to invest in a company that's not legally protected. And then increasing the assets within the business. So we'll talk about that more in depth, because it goes back to kind of creating this ecosystem of revenue always coming in. And then preparing for an acquisition. You can't just wake up one day and say, I want to sell my company, unfortunately. You have to actually go out and prepare. You have to generate a market. It's kind of like when you are going to market for your own business. You don't just wake up one day and say, I'm going to start a business. There's branding, there's prep involved, and it's the same thing whenever you want to sell. So I'm going to help you guys learn how to do both using my framework, gain, sustain, retain. It's just a very cute name to just say that we're going to make a lot of money, but I want to make sure that you also know how to manage a lot of money. So gain, it's all in how you generate money. I think everyone in this room has mastered that in some capacity of how to make a lot of money. But I want to teach you guys also how to go to that next level. And then sustain, this is all in how you manage the money. If you make $1 million, but you're only profiting $10,000 a year, it's irrelevant. You're doing this all for nothing. So I want to get us out of that hamster wheel of making so much but not keeping it. And then, of course, retain. This is how you keep and grow your money. This is all through leverage. And this is how businesses are able to scale from 1 to 10 million. They're using leverage, and I'm going to show you guys exactly what that means. So first, we're going to get into gain. Gain comes down to 2 things, value and value. So value is how much someone is willing to pay for something, and value is how much you're actually able to distribute or sell. So mastering value is what got you to 1 million, but now at this point, you're probably likely the bottleneck. There's something in the business that's stopping you from getting to that next level. And that's because you didn't really master the value phase. So in order to hit 10 million, you need to scale without multiplying the workload. If scaling and going beyond in business means that you have to do more or that your to-do list is longer, then you're doing it the wrong way. So I want to talk a little bit about value because, like I said, I feel like you guys have all mastered this in some capacity because by the looks of the goals, you guys already have high revenue numbers. But I want us to scale. So it's really about perception and pricing power. Every time I'm working with a business that makes less than $5 million a year, I always advise premium or luxury pricing only. The reason why is because we don't have the luxury of being the Walmarts and the Targets competing on price. You're always going to lose. You need enough money to not only pay yourself, but pay the team, marketing, build out this infrastructure, build out this tech platform, and you simply cannot do it if your profit margins are less than gross profit margins are less than 70%. So you have to grow up. But in order to do that, you have to really master brand perception and pricing power. That's really just what people think of the brand. And I feel like all of you guys have some sort of idea about branding and brand strategy, but it's really now it's time to master it. Because we have to kind of get out of average or premium pricing. Get out of average or economy pricing and get into premium or luxury. My favorite case study for this is Erewhon. Are you guys familiar with Erewhon? Okay, yes. I thought it was a joke when I first heard about it. So for those of you unfamiliar, it is a high-end luxury grocery store, and I can't believe I'm even putting those two words in the same sentence, especially in this economy, but it's true. They're a high-end luxury grocery store. They have valet parking. They have ice for $30, sea moss for $60, and this is right now during a time where people are complaining about the price of eggs. So how is Erewhon getting away with this? It's because they never wanted to play the pricing game. It was all about perception. They are selling an aspirational brand. They're competing based on value. They're competing based on brand positioning. And no one else is in their lane. Not Whole Foods, not even Sprouts. And this is a very small company. They only have 10 locations. Each location averages about $19 million per location. And they make about over $2,500 per square foot. That is more than Trader Joe's, that is more than Walmart, and that is more than every other grocery store competitor. Now, of course, Walmart is still here and all these other corporations still make more than them, but per location, they are dominating the space. Why? Because they're playing a game of perception. They're playing brand positioning. At any time, you can see Angelina Jolie, Miley Cyrus, any of the Jenners, Kardashians, and these locations. They love walking around West Hollywood with the Erewhon bag. That's how powerful it is. Now, if I were to tell any one of you guys to start your own grocery store and I want you to generate $19 million in the first year, you'd probably think, okay, I need to have the best grocery store products. I have to have the best aesthetic like Target. I have to get it at the cheapest price. Erewhon did none of those things. They only focused on making the brand aspirational, and that's why they were able to dominate and become successful so quickly. At this stage that you guys are in, if you want to scale to 5, 10 million, you have to be playing the perception game. You have to be playing a game of value. When you think about the Birkin bag and why people would willingly pay 10, 20 times more for a bag, it's all in their mind. It's all in what they think of the product. Hermes isn't the only place that sells quality leather. But when you lead with story and you lead with narrative, you're able to make significantly more. People pay more when they believe that you're the only real option. Okay, you're in a lane of your own when they believe that you're the only real option. Like I said, Erewhon has no real competitors, not even Whole Foods, not even Sprouts, because they've created their own lane, they created their own niche, meaning you can charge whatever you want for it. When you think about Apple, we don't call it a phone, we say an iPhone. They created their own lane. We don't say a desktop, we don't say a laptop, we say a MacBook. Now that they created their own lane, we willingly pay $1,000 for a phone and don't blink an eye. That is the power of creating your own niche. If you don't master this, you're gonna always try to play catch up. The moment you make $100,000 or extra $500,000, you're spending it again. You're investing in marketing, you're investing in ads, because you haven't really mastered aspiration and building a brand that is highly in demand. So how to win the value game. So I want you guys to stop focusing on getting to that next level by selling more. You can only sell so much. I want you guys to also look at the licensable IP. So we all have this, but we want to move beyond selling your product or service and developing frameworks, formulas, or processes that others can license out. So for example, I have a client, she's in an HR tech company. She matches up executive leadership roles with companies like yours, like small to medium-sized businesses. Now, she was doing fairly well, but it was very, very slow traction. You got to get on a call, you got to sell to the corporation, you got to hope that maybe that you can get the CEO. The moment we implemented a licensing model where they license out the software to the corporations, the business scaled. Because what we noticed is that their number one thing is they want full control of the ecosystem. They want full control of the branding and how things look. So once she licensed that out, the business scaled tremendously, and she now only has 3 CEO days a month where she shows up and actually works, because she just built different revenue streams within the business. Of course, she could have sold more. She could have tried to get more customers, get more corporations, but it would have been a hamster wheel of constantly gradually going up, spending more money on marketing and ads, and instead we're being strategic. Next is enterprise level brand equity. Brand equity is just what people think of the brand. It's what people think of you and think of the industry. So you want to make sure that the brand equity is in your favor. And then investors and consumers don't just buy offers, they buy the perceived value. So this is what does the press say about you? What does social media say about you? Because in 2025, you are who Google says you are. When I look up your brand and I look up your name, that's it. That's what I'm going to think of you. So you want to make sure that all that is in your favor. And then strategic partnerships. This is one of my favorites because it takes significantly less money in order to master. So recently what I noticed is when you go to 5-star hotels, Le Labo is always in the bathroom. I'm washing my hands with it, I'm in the shower with it. I was like, okay. So by the time I leave the 5-star hotel, I'm already ordering it, so when I go home, I can go home to it. Instead of investing more money on ads or more money on marketing, they got a strategic partnership to always be where their consumer is. They know that their consumer invests in 5-star luxury hotels. So now they have a partnership with that hotel to get directly in front of them. Not only are they in front of the customer, but you're using it for the entire duration of your stay. So what do most people do? They go home and now they can't live without it. That is the power of strategic brand partnerships. And this goes beyond just, I'm going to run another ad, I'm going to focus on social media. You have to get where your consumer is. There's someone out there who has your customer. You need to get in front of them and you need to work out a relationship with them. And then data systems driven delivery. So I hate to break it to you guys, but we are a data business now. We're not in the business of delivering products or service. We're in the business of data. This is why every single time you go on a website, accept cookies. They want all of our cookies. They want all of our information. Now, brands who do this, ethically, they're just collecting the data so they can give us a better experience. And that's what I want you guys to do. I want you to collect as much data as possible on your consumer so you can deliver a high-end brand experience. When I go in and get my hair done, they don't ask me what I want to drink. They just go ahead and give me a matcha because they know last time when I came, that's what I got. And that is the power of personalization. Marriott now, the CMO of Marriott said that they're starting to track the consumer's shower temperature. So every single time you go to a Marriott all across the world, you're going to have the same shower temperature. And of course, they're collecting, data of like what the wake-up call is and all these different things. And that's so that they can curate a personalized experience. Personalization is no longer luxury. It's going to become the norm. It's going to become the standard. So you have to be leveraging this data in order to incorporate it into the delivery of your product or service. Okay, so we broke down value, which is all about brand positioning and visibility. Now I want to talk about volume because I think that's what most people struggle with. Now that you have the demand, you have people coming to you, you have this aspirational brand, how do you deal with the demand and the inflow of customers? Infrastructure, team, technology, or your business model. Those are the 4 ways to scale the business. So this is your ability to scale and grow beyond the limits of your time. If the business needs you at any point in time in order to get to that next level, it's not investable. It's not desirable just yet. So I want to help you guys get out of that so we can build an investable company. Starting with scaling through infrastructure. So this is pretty straightforward. If you have a product-based business, this is typically the way you're going to scale. You're going to have to scale by either upgrading the facility, updating the warehouse, updating your machinery, so that way you can take on more. When you're upgrading the infrastructure, your whole purpose is just to support a higher output. So that way, if you got an influx of, let's say, 50,000 orders, 50,000 customers, you could be able to support that. And it all comes down to the infrastructure that you have. But if you are more digital, which I know a lot of us are, you have a digital or agency model, you want to scale through your team. The issue that most women have is we just hire people. The interview goes great. It's like, I really liked her. She was so nice. And then we're just hiring them. Stop. I don't want us to do that anymore. I want us to hire more leaders. Because what happens is a lot of the times your P&L is bloated with people, but you're still in the weeds. You're still in the day-to-day. So what you want to do is you want to hire more leaders. You want to hire more thinkers. So most of the time we're hiring hands. And that doesn't mean that these people are dumb by any means, but it means that their job, they just get the job done. They go in, you want me to answer emails, I'm going to answer emails. You want me to do customer service? I'll do customer service. You want me to deliver the service? I'll do it. And that is it. They're not having any real strategic input. And so that means that when you lay down at night, all those thoughts, all that anxiety lays on you because you have no one else thinking on your behalf. Now, the 4 main areas that you want to hire in these positions is going to be marketing. Obviously, that's number 1. Sales, that's number 2. And then operations, and then finance. And this is always a shock because I'm in finance, but I always tell people I am the last leader that you hire because if you're not making money, I cannot help you. So the reason that you want to do it in this order, because marketing, that's the utmost important. You need visibility. You need people that want the brand. And then sales. You need someone that's going to know how to close on your behalf. Of course, operations. You need someone who's going to master the infrastructure. If you got an additional number of customers and leads, who's going to be the person in charge? Because if it's going to be you, there's always going to be a cap. If you know that you want to scale to $5 million, $10 million, what does the operation seriously need to look like in order to get to that next level? What leaders do you need on your team to get to that next level? That's why I'm so glad you're like, I'm going to have to fire my whole team. Well, I'm not glad. I hope you really don't. But I hope they learn to just kind of level up to the occasion. But that is the reality. It's most of the time your team is not ready for the next level where you want to go. And so you're going to have to cut the dead weight and get more strategic people in there. When you think about any Fortune 500 company, they have headhunters. They have people who are actively going out to the other best companies and saying, hey, we want your CFO, we want your director of operations, because they know the power of having smarter people in the business that have already been where they want to go. So obviously, we're not at a point where you can hire all these people full time, so I'm not asking that of you. You can do contracted, you can do part-time. You just need someone who has gone to the levels that you want to go to that can help you get there. Because if you're the smartest person on your team, you're always going to be the bottleneck. And then scaling through technology. This is my favorite. We are in this AI era. We are literally just cracking the surface. We're on our way to quantum computing. This is one of the best times, in my opinion, to be alive. Now, despite what you may feel about AI and the direction of where it's going, it's here and it's not going anywhere. And so the brands who are stubborn and who's like, I don't want that, AI is terrible, they're taking all the jobs, they're killing the planet, you're gonna have a very, very difficult time for these next 5 years. Because the brands who are innovating, they're adapting, they have to AI, they have technology, and they're utilizing it. And right now, it's very inexpensive. Like when you think about the cost of what you can use ChatGPT, all these other platforms for, it's very cheap and it's not gonna last that long. Eventually, they're gonna go up drastically on the price. So I advise you guys to start using it right now. Now, when it comes to technology, I don't want you to implement technology for technology's sake. I don't want a chatbot on the website. It's just kind of unnecessary. You know the feeling when you call AT&T and you have to hit 1,000,001 numbers before you get to someone, and then when you get to someone, they can barely understand you? So that's not what we want. I don't want you guys to just do it for the sake of doing it and just to replace people. I want you to do it where it makes the most sense. So we talked about Marriott tracking the temperature, the shower temperature. That's pretty insane, but that's a good reason to use technology. So you want to have a good reason to use it. Maybe it's just replacing a very long onboarding process. Maybe it's replacing the sales process. Whatever it looks like, you guys know your consumer best, but you have to use it. The quality of your tech stack will determine the success that you have in the next 5 years. Ask ChatGPT, this is my business, this is how I operate, this is how I deliver the service. What technology can help me do this better and faster? And then business model. So a lot of business models, I would say post-COVID, have changed drastically. The clients that were primarily offering services are now out offering digital services and offering products. The ones that were offering products are now offering memberships. Everything is changing so much because the consumer has changed so much. So don't ever be afraid to change your business model. You guys probably realized that when I was like, what is the annual revenue goal if you were to make it per week? A lot of times that means you would have to change what your business model is. Instead of offering just services, maybe you realize I have to offer retail. Maybe you realize this has to be a tech platform in order for it to scale. I want you to think that way, and I want you to start thinking, what does my business model need to be in order to get to this big goal that I have? Because chances are it needs to change. Now, the part that everyone doesn't really like, sustain. This is the most boring part of business. And if you guys are visionaries and you're creative thinkers, you may really struggle with this because it's very mundane. In order to sustain the level of success that you have, you're gonna have to do the same thing over and over and over again. You're gonna have the same meetings, look at the same KPIs, looking at the same metrics, and it's very, very boring, which is why a lot of visionaries hate this stage. That's why you just hire the people who like this stuff. There's people who, they can't stand doing different things every day. And these ideas that you spit at them, they're like, okay, this is too much. I wanna just maintain. This is where you wanna hire those kind of people. Your operations person, your finance person, they should be very boring. They should like this stuff. Which they usually are, except me, of course, but which they usually are. Okay, so making money is just step one. Managing it is step two. Like I said, I don't care if you have a $10 million business. If you're not keeping anything, you're doing this all for nothing. So you have to figure out how to sustain it. It comes down to your budgeting, it comes down to cash flow management, and it comes down to profitability, and of course, removing the owner dependency. We want it to be completely independent from you, so that way it can sustain itself without you. Every dollar needs a job, which I'm sure you guys know, but I don't want you to just budget just for the sake of it, okay? 50% is going to operationals, 10% is going to marketing. We want to make sure that we're budgeting for growth. So if you know that you want to scale to 5 million, 10 million, whatever that looks like, what do you need to invest in right now to get there? And what do you need to continue investing in? That's where the budget comes in. And then cash flow. This part is really important because most of the time you guys are looking at the P&L statements, you're looking at the balance sheet, but you're not really tracking cash flow. You're not really understanding the cycle of how money comes in and out of the business every single month or every single quarter. So what starts to happen is you have some of those months where you're like just playing catch up. Where it's like we made a lot of money, then we just spent it all on payroll. We spent it all paying this contractor. And that's because you're not really actually managing and tracking cash flow. Your cash flow must be forecasted. So every 90 days, you should have some sort of idea of what that quarter is going to look like. So that way, if there's any hiccups, if anything is going to come in and maybe put you guys in the red, you already know before it happens. It shouldn't be a shock or a surprise to you. I don't expect you guys to do this, but maybe someone on your team from a financial perspective should be doing this every single 90 days, and you guys are touching base. And then profitability. This is why I like to start out with the pricing piece, because how profitable you are comes down to the price. That's like the first number that we start with. If someone pays you $1,000 and then you paid the contractor who delivered the service $500, now you're left with an additional $500 to go pay for marketing, to pay yourself, to pay for the software, to pay for sales. It's just not enough. So like I said, when it comes down to profitability, you have to be having that 70% or more. And then when it comes to net profit, I would say a healthy net profit margin is about 30%. So meaning after you've paid all the expenses, what did you say?
When you were saying 70 without net.
Oh, that's right. Yeah, so 70% is the gross profit. So that only means immediately after the direct cost. Then after that, after you've paid everything, you should be left with 30% net profit. This is a healthy business, okay? If it's 25, 30, that's fine. But anything below that, you're just gonna run the risk. So profitability is so important because you cannot expand, you cannot scale without this. If you wanna go to the next level from where you are now, it's gonna be done with the profit that you should have in your account. So we need to make sure the business is profitable. And then removing owner dependency. This is my favorite because I've had so many businesses come to me and they're like, I want to sell, I can't wait to sell my business. And then we start sitting down and we're going through everything. I'm like, who does this? Who does that? Who does this? Oh, me. What owner is going to want to buy this if you're doing everything and you're leaving? This is meaningless to them. And it's very hard to have those conversations because they're like, well, my business isn't worthless. I have 5 million, I have 7 million. It's not about that. If the business depends on you to make money, it's only valuable to you and no one else. So we have to remove you out of the business if we want to be able to sell it. And honestly, even if you don't want to sell it in the future, you want to be removed from it. I'm sure you have other ideas and other ventures that you want to go on and pursue. So don't be trapped into the business. It becomes a trap very quickly if you're not strategic and knowing how to remove that owner dependency. The best way to do this, honestly, I want you guys to make a little T-chart, so a line down the middle, horizontal line, and I want you to write the 4 main areas: marketing, sales, operations, and finance, and then write everything you do for every department, whether that means approving payroll, whether that means still getting on the sales calls, listing out the pricing, doing the budget, approving budget, whatever the task is. And then we're gonna create a plan every year to slowly remove all of those things. Okay, so the reason why most people can't master sustainability is because it's very habitual. It's about systems and routines. And you'll notice that the more you scale, it becomes more systematic. This is why when you think about every Fortune 500 company, it is ran on systems and tools, not people. Whether someone is there today or gone tomorrow, they can replace that role immediately because they have the tools, they have the systems and the SOPs to be able to do so. They've built something that works like that. It's more of an engine. And that's exactly what you want in the business, but it's very difficult, especially as a CEO, because you have all the ideas. You're the creative person. So this is something that you delegate. Your role as a CEO now, from this point on, is to measure the success of where you're going. So let's say you have someone ahead of marketing, sales, finance, and operations. What are their KPIs? They have to have KPIs for their role. You tell them, I want to go to $10 million in the next 3 years. And they'll give a plan of how they're going to actually do it. Now you have KPIs and metrics to track the success. That is now your job as CEO. It's not actually going in and doing the work. It's to make sure that the vision is actually being executed on your behalf. So this is kind of just some simple routines that I like to do or make sure that it's done for my clients. So daily, reviewing the sales report. So every day, someone should be sending you a sales report of how much you've made and typically how much you spent. Weekly, updating bookkeeping and dashboards. I'm not one to love bookkeeping being done at the end of the month. It's already done. What use of it for you knowing if the month is already over? So if you're learning about what happened in March and April, that's no use for you. You need to be having bookkeeping done weekly in some sort of report. That way, if something is going wrong, if there's fraud going on, if money is going out faster than it's coming in, you guys are able to immediately stop and pivot. When you are making 1, 2, 3, 4, or 5 million, you should not be waiting to the end of the month to find out what happened with your finances. And then monthly, that's when you kind of get the fancy reports. You go everything in depth. You're reviewing the budget. I don't want you to just budget. I want you to actually now budget and review it. How much did you plan to spend versus how much did you actually spend? And what was the difference? And then holding the CFO accountable of why were we off? What's going on? Why are we spending more than we had anticipated? And then quarterly, reassessing the budget. So maybe now the next 90 days going forward, some things change. Now you're investing in something slightly different. And then, of course, you're looking at the goals. And then annually, setting financial plans, reviewing the long-term strategies, and creating a list of tasks that you'll delegate. And this is also something good to do in your personal life. If there's something that you're doing in your personal life that you know that you want delegated, create a plan every single year. These are all the things I don't want to do by the end of the year, and figure out who's going to be the person to replace you. And then retain. Now this is the fun, sexy part about money and wealth, and when people think about being rich and successful, this is usually what it comes down to. It comes down to how well you retain money. So it's really about being able to protect and multiply the money that you have, and it comes down to your reinvestment strategy, asset acquisition, and your strategic use of debt. So the reinvestment strategy, this is similar to a budget, but it's completely different in the terms of you're just looking at the profit only. So if you know, let's say by the end of the year, you're going to profit 100, 200, 300,000, what are you going to actually do with it to create growth? Now you're shifting from thinking like a CEO to a wealth advisor, where it's like, I have this much money that I want to turn, let's say 300,000, I want to turn it into 600,000, I want to turn it into $1 million. Realistically, how am I going to be able to do that? What investments do I need to make? Which is why I asked you guys in the beginning, what are the top 3 things that need to happen in order for you to get to that next level? If you aren't sure what needs to happen for you to create this $10 million business, then it just won't happen. And if you don't know, sometimes that's okay. You need to reach out to someone who does. What does my operations need to look like? What do I need to be investing in? How much money needs to go to marketing if I know that's the level of scale that I want to get to? Or maybe I need to invest in another business. But that's the point of the reinvestment strategy. You're solely looking at the profit that you're anticipated to have and saying, where do I put it? Sometimes it's in your team, sometimes it's in the equipment, it's in the technology, it's in the infrastructure. It really depends on the level that you want to go. Wealth follows assets. If you don't listen to anything else I say and everything else goes out the door, this is it. Wealth follows assets. If you want to be wealthier, you want to be richer, you want to be more successful, it all comes down to assets. When you look up how to be wealthy on whether it's TikTok, Instagram, Google, all these long blog posts and all these long drawn out videos and buy my course, it's all in assets. That's what money follows. It's an exchange of value, and the value comes from the asset. There's 2 types of assets. That's the assets that hold its value. So think about something like gold. It's an asset that retains its value. You don't just make money from having gold, but once you want to sell it, that's when the value comes. So in business, it's your intellectual property, it's your IP, it's the trademarks, it's the patents, it's the copyrights. You're not actually making money on it from it right now, but when it's time to sell it, you will, and it holds its value. Your brand equity, your customer list, and your data. A well-organized CRM are key right now, because that goes back to the personalization and delivering a data-driven business. So the customer lists and the data are also really key. There's been several times where we've sold a business that was probably worth $5 million, and we've been able to get 7 out of it just from having a quality customer list, where we're like, well, we have an email list of over 30,000 people, of high-end affluent individuals. So really all these things, they may not seem valuable to you right now, but if you were to sell, it's something that you're going to want to have in your arsenal for when you're negotiating. And then, of course, company-owned real estate. I don't have to talk too much about that. Real estate always has its value. And then your digital presence, so your website, your social media following, all that is absolutely valuable right now. There's social media pages that are being sold for $100,000. So if you have a quality social media page and you're gearing up to sell, again, that's just another good negotiation factor for you to get a higher price. And then income generating assets. Obviously, you need this to be able to support the business. So it's not so much about just selling the products or service, it's having a full ecosystem of assets within the business so you're always making money. So whether that's having a subscription-based model in addition to everything else, retail products in addition to services, licensing agreements, franchising, affiliate or partnership programs, all of these things make a huge difference because they all help you make money. I actually just made a post recently that was like, I don't believe that you should have multiple streams of income until you've mastered one. So once you've mastered one, maybe that's selling the product or selling the service, then you move on to affiliate or partnerships. Then after that, then you move on to retail products. Then you move on to subscription. You want to make sure that the business is making a sufficient amount of money through that income stream before you start moving on to the next one. All right, acquisitions as a growth strategy. Every single company that is major that we know that's a household name has acquired another. Google acquired YouTube and Android. Amazon acquired Whole Foods and Zappos. Estee Lauder acquired Too Faced. Coty Inc. acquired Kylie Cosmetics. I can literally just go on and on and on with the amount of acquisitions that happen at a mass level. But also on a micro scale, when you think about companies that earn 1 to 15 million, they're also acquiring smaller competitors. You can't just grow organically. And when I say organically, I just mean through marketing and sales and constantly pushing, because you're going to always hit a cap. You can only spend so much to grow so far. So this is why they actually acquire the brands, because you're able to get to your goal 10 times faster. So billion-dollar brands aren't born, they're created through acquisitions. So whether you guys want a billion-dollar brand or not, you kind of want to think like that. Of how do I build the next big thing? It's finding out who has the exact customer that you want and acquiring them. And this isn't just for the larger brands. You could acquire a brand for $300,000, $200,000, $500,000. You could put a small amount down and then finance the rest. I feel like everyone in here should be thinking about that as the next step. Now, this is the last step. That's why I said this is the sexiest part of making money, because it's after you've already mastered how to gain and how to sustain your wealth. this is the final step, is that you want to figure out how can you acquire the next brand in order to grow beyond yourself. So how to begin? First thing you want to do is identify the funding sources. Where are you going to get the money? In my opinion, I don't recommend all cash. We'll talk about that when we get into the debt piece, but you want to figure out how much you have and where you're going to get the rest of the finances. And then you're going to pinpoint your target. I don't want you to acquire a brand for acquisition's sake. Well, Shay told me I have to buy something, so here I am. Let me go find a brand to buy. That's actually not what you're doing. You're acquiring for a strategic purpose. So, for example, when you think about Pepsi just acquire Poppy, Pepsi is a very old, long-standing brand. Like my mom, every day I have to get a Pepsi on the way home for her. That's their consumer, right? It's like that older person. Poppy has the Gen Z, they have millennials, and they're very health conscious. They have a different consumer that Pepsi would never be able to tap into, just because the consumer doesn't think of Pepsi when they think of the ideal drink. So what do? They acquire Poppy. Now they have access to that consumer. When you think about the brand LVMH, they own Tiffany's, they own Balenciaga, they own almost every luxury brand that exists, because now they're tapping in, they're expanding just by acquiring all these small brands because they want the consumer. It's easier to acquire them than go out and actually invest more in marketing or invest more in advertising. Integration plan. I recently had to consult with an investor who purchased a salon. 8 months later, they were ready to sell it. And I was like, well, why do you want to sell it? It's just not going well. It's losing money. They had a location in Costa Mesa, and then the other location was somewhere in LA. And the one that was in LA was very successful. They have to keep using that money to fund the one in Costa Mesa. I said, okay, well, what was the integration plan like? She was like, well, I didn't have one. It was just a nice location, and we just decorated and added staff. That is not the way to go about an acquisition. You have to have an integration plan. How are these two companies both going to be the same, and how are they going to be successful? How are you going to integrate the team, integrate the systems? All that has to be thought of before you make the purchase. You have to think so much like an investor, because they're going to sell you everything that's great about the company. We have this many customers. We have this much on our email list. They're going to tell you all the good things. Like when you're going to go buy a house, and they tell you all the good things about it, but they don't tell you they had termites last year. They don't tell you, they don't tell you all the things that lie underneath it. So you're going to have to figure out, okay, worst case scenario, how are we going to integrate this brand? And that is done through an integration plan. If you can't figure that out and you start going through, like, this is not going to be integrated, these teams won't mix, our systems won't mix, then be ready to walk away and then go after the next one. But this part is so important because so many investments fail because you don't think this all the way through. Now, leveraging credit and debt. It is one of my many missions to make sure that women are not afraid of debt. Because this, even sometimes the word, it really gets shamed. But it really gets shamed when you have debt. And then when you think about traditional finance, the media, the debt is bad, interest rates are terrible. And everyone is just very fearful of debt. And it's so funny to me because I'm like, have you seen America? We're trillions of dollars in debt. Every Fortune 500 company, hundreds and thousands of millions of dollars in debt, and they're majorly successful. Because debt is not bad. When you use debt to buy stupid shit and liabilities, of course it's terrible. When you use consumer debt in your credit card and you have 25% interest rates, of course that's something you want to get out of. But when you're using debt to acquire assets, that's the best thing that you can do. So using debt is using other people's money to scale faster while protecting your liquidity. Smart debt is a tool for exponential growth. If you want to scale fast, I'm not talking 1 million one year, 2 million the next. I'm talking 1 million to 5. It's going to always be done through debt. So you want to think about that when you are leveraging, trying to buy a business, buy an equipment, expand your infrastructure, expand your tech. It doesn't always have to be your money because it's always going to be a cap to how much you have. You have to pay yourself. You have to pay the team. You have to pay marketing. You have to pay sales. You can't afford to always go out and purchase that next business. You can't always afford to invest in that software development. So you want to leverage debt in order to do it. And that's what every wealthy, successful business has done. But debt is always shamed when you look at it in mass media. It's always shamed when you look at it from a traditional lens. But the reality is every country is in debt. Every massive business is in debt. It just is what it is because everyone knows that debt is the tool to go to the next level. Raising capital. So this is kind of my area of expertise. I want to break it down just a little bit because I know some people are scared of raising capital, whether that means an investor, a bank, maybe you're scared of the loan, maybe you are scared of someone taking equity in your business. So I want to kind of break that down so that way when we get into the Q&A portion, you guys have some sort of context. So the funding stage. There's pre-seed, seed, Series A, Series B, and Series C. I won't get into Series B and Series C because that is just typically like a massive company, like $20, $50 million plus. So we don't have to get into that. But pre-seed, this is when you need the money to develop your idea into a product or service. So you have absolutely nothing yet, but you're like, look, this is going to be the best thing since sliced bread. I need $100,000 to get started. This is commonly what we've seen like in the VC space with tech companies, like a Google. They're like, look, I have this great idea, but I don't have the money. So you don't have anything yet, just the idea. That's going to be pre-seed. Now, this is very difficult to raise because how many of you would just give someone money just for an idea? We all have great ideas, right? So this is very difficult, but it is possible if you've had a business and it was successful and you sold it, or if you have a name, or if you have that brand equity we were talking about, where you're like, well, I've built a $5 million company, I just need this money for this other idea. It's just more likely to happen if you've already have some sort of track record or resume for doing something great. But the next one is seed. This is when you need to bring the product to market and gain traction. So you have some sort of product, you have some sort of software company, you have a service, and you just need to bring it to market. I need to invest in marketing. I need to invest in the team. That's when you would raise seed. Okay, so this typically comes from angel investors, crowdfunding, there's venture capitalists. So these type of investors, they like coming into an idea early, but again, it's going to be about you as the founder. Can they trust you? And it's going to be about the team. Do you have the team? So that's oftentimes what the number one question will be. It's like, hey, I need $250,000 to get this idea off the ground. It's going to be like, well, let me see the team. Do you have a team that can actually scale this to 5? And if the answer is no, then chances are it's going to be very difficult for you to raise. And then the final one that we're going to talk about is Series A. This is one of my favorites because this is something that everyone in this room is capable of raising. So this is where you've already proven market fit, you have customers, you have people that love the product. At this point, you just need the money to be able to scale operations. You need to invest in the infrastructure. You need to invest in the new location. So this is where Series A comes in. This comes from venture capital firms or angel investors. These are people who like to get in relatively early and they want a hefty return. They want anywhere between 7 to 10x at the very minimum. But everyone in this room should be thinking about some sort of Series A raise if you want to scale to that next level because you don't need your own money to do it. And there's investors who are actively looking for women out there like you. So I know there's like this connotation that only 2%, I think, of women actually get VC funding, which is absolutely true. But there's also a lot of investors who love to invest in women. They want to invest in women, but you guys don't know how to ask. I've seen so many pitches where I'm like, is she serious? Because she didn't, you guys don't even ask. I've seen a pitch where they've gone through, it was a biotech company. And it was amazing. They were able to tell if you had a cancer by scanning your eye. So I'm like, this is great. This is going to be something phenomenal. She gets up there and she pitches and she gives the science and the data. And I'm like falling asleep. And she never asked for the money. She just said, okay, that's a great idea, and walks away. Women, we're afraid of asking. Ask for the money because this isn't a charity case. Investors need to put their money to work just like everyone else. So I think oftentimes women are like, oh, I don't want to ask. They kind of get scared, or you don't really want to have those kind of conversations because pitching yourself is very difficult. But the reality is you have to if you want to scale to that next level. But don't be afraid to just ask for the money. I need $250,000. I'm going to make it into $500,000 within this amount of time frame. Here's exactly what I'm going to do. That is it. That's the ask. Shut your mouth and then see what they say. Oftentimes, women, we don't do that. So I want to encourage you guys to ask a little bit more often. Funding sources. So this is just some different ways where you could actually fund and get the resources that you need. Financial institutions. So these are banks, private lenders. These are just a little bit more easily accessible. So banks, I'm not a huge fan of just because of the interest rates. It's determined by the market. And then there's no real flexibility. So banks sell debt as a product, meaning it's predetermined. Like your rate, you may be able to gauge it just a little bit, but everything is predetermined. The terms of when you're going to have to pay it back, all that is pretty much set in stone. So yes, it's easily accessible, but you don't have any real negotiation power. Crowdfunding, this is becoming a little bit more popular. It's just where you raise money from a bunch of different people. So if I was crowdfunding, I would raise money from every single person in this room and you guys give me a set amount. It's not as popular, but I'm starting to see it, more and more as with social media and people having access to more people. Angel investors, this is going to be the most common. So an angel investor, we've all heard of them. This is someone where they invest in businesses like yours. They typically have some sort of industry knowledge or expertise, and they can typically offer mentorship along with their investment. And they typically want to invest in something that they already know. So let's say you have someone who owned a marketing agency, they sold it for $10 million. Now they're an angel investor in other marketing agencies. So you want to find someone who kind of already has that industry experience that can provide you advisory or connections. And then venture capital, this is more so only prominent when you have, honestly, if you're in tech, if you have a tech or software company, it is harder to get funding from them because they want massive returns. But it is something to think about because when you want to get investment, it is better to go to a financial institution just because you know they have it. They have a massive amount of money. They have anywhere between $20 to $50 million in deployable capital that they have to get rid of, meaning they can't sit on this money. An angel investor doesn't have those same premise. They may only have $100,000 to spend for that year. So just to keep that in mind, because I know a lot of women are like, I want an angel investor, I want someone like that. The reality is it is harder to find in comparison to something like a venture capital or private equity firm. Now, why do these investors provide capital? The reason I want to go over this is because if you guys are ever, whether that's now or in the future, want to raise, you have to have a clear understanding of why someone in their right mind would give you money for this idea. So when it comes to an investor, they just want returns. They want high returns on their investment. They want their money to work for them. So they're not doing you a favor, you're not doing them a favor. It's like, hey, you could leave your money in the bank and get 0.0001 return, or you could put in the S&P, and we've seen what happened in the stock market, or you can give it to me and I'll generate a return for you. And if you need proof, take a look at what I've done in my business from the past 3, 4, or 5 years. This is how you know I know how to put your money to work. So it's a very equal exchange. So you're not going in there being a charity case. You're going in there showing them that you can put their money to work. And then banks, they want security. So if the idea is risky, if it's new, if you've never done it before, it'll be a hard no from them. They typically only invest in, like, if you need money for a PO, if you need money, and you have a healthy cash flow and your business has been sustainable thus far, then they'll give it to you. So banks just want security. So please don't go in a bank like I have the best, newest idea. That's very scary for them. You want to kind of lean in more with a very safe investment, because that's what your male counterparts are doing. All right, so I want to recap the gain, sustain, and retain framework before we get into the Q&A. Gain, like we talked about, is all on how you make money. It comes down to the brand perception. It comes down to visibility. You have to have that pricing power. But in order to get that, the brand has to have some level of aspiration to it. Think about Erwan or Hermes. Sustain, this is the most boring part of the business, but it has to get done. This is where you have that financial stability, profitability, and this is where you're building a business that's actually ready for the next phase of growth. And then retain. This is not about hoarding your wealth. It's about protecting and multiplying it. And you're going to do that through a reinvestment strategy. You're going to do that through asset acquisitions and a strategic use of credit. All right, Q&A. Any questions so far?